Think about every stock that's ever been listed on the New York Stock Exchange. Most of them don't exist anymore. Well, maybe stocks don't always go up. Maybe if I take an average stock, it actually has a propensity to go to zero. Hello, and welcome to episode 3 of the Wall Street Iceberg series. For those of you just joining, we are covering a 9-tier iceberg that was found on Reddit. It follows topics relating to securities and investing, alongside examples of controversy and fraud in markets, and eventually it dives into outright conspiracy theories. And today we're going to be looking at tier 3 of the iceberg. Now this is going to be a long one, so we're going to break it into 2 or 3 separate parts. But without further ado, we'll get kicked off today with 10 of those topics. So let's go ahead and jump in. The first topic we'll be covering today is market makers. So market makers are dealers of securities. They both buy and sell securities, and they make sure that markets have liquidity in them. They make sure that participants in the market can buy and sell their own securities without much friction. Now, the way that market makers profit is off of the spread between the bid and the ask. Now, in the last episode, we talked a bit about spread between bid and ask, but what it is going to be the difference between the price at which a market maker is willing to buy a security and the price at which they're willing to sell it. So for a market maker, the bid is the amount that they're willing to pay for a security. For the market maker, that is the lower price. The ask is what they're willing to sell it at. So for example, let's say we have Apple stock and the market maker might have the bid at $100 and the ask at $101. So they're happy to buy the security for $100 and they're happy to sell it for $101, and the amount that they profit is that $1 spread. Now you as the investor, you go to the market maker and you pay that spread for the service that they're offering, the service of liquidity. So you would be buying at the high price and you would be selling at the low price. A lot of market makers actually attempt to stay neutral on the price of the security, and they're more concerned just about capturing the spread. They're not concerned about whether the price of Apple goes up or whether the price goes down. They'll hire people to make sure that regardless of price action, they can maintain profit on the spread. Most of the time, they are providing liquidity from their own inventory. So in turn, it's just going to give more price stability to the markets. Now, market makers are going to be heavily regulated. They operate under exchange bylaws, and they're going to be governed by the SEC. And there's a few different types of market makers. There's also what are called DMMs, or designated market makers. And these designated market makers hold a monopoly on the flow of orders for a particular security. So these designated market makers are used by the New York Stock Exchange. So they'll post bids and asks for the entire market to see, and it's their job to make sure that pricing integrity is maintained and people are always getting the best price when they buy and sell. Now, the designated market maker, they set the opening price for a stock each morning, and they base that off of supply and demand. Now, as a designated market maker, there's a few things they can do to set the price to make the market look a bit rosier than it might actually be, or they could make it look a bit more scary than it actually is. And this type of manipulation isn't technically legal, but there's a famous clip of Jim Cramer talking on an internet talk show before the internet was big, saying that the SEC just isn't smart enough to understand what market makers are doing, so it's easy for them to manipulate prices pre-market to move the price way up or way down with a small amount of money, which to them, would be $10 to $20 million. So one of the ways they can manipulate the price pre-market is to flood the market with sell orders. This might also be referred to as stop loss hunting. So you have a lot of people when they buy a security, we'll use Apple for example, they'll set what's called a stop loss on their order. So let's say they buy for $100 and they don't want to lose too much money. So if the price drops down to $95, they'll have their account automatically sell it. So if they're at work, they don't have to watch markets constantly. They know they won't lose more than 5% in that instance. A lot of times these stop losses are set on round numbers. It's just a part of human psychology. So when market makers flood the market with sell orders, it can trigger these stop losses. And if they trigger one stop loss, it's going to trigger others, and it has this cascading effect. So for example, a designated market maker could pre-market move the price of a stock from $100 down to $95, and then trigger a bunch of stop losses that further take the price down to $88. And once they have this, false impression of supply dropping, they'll buy it back at the bottom, and then they'll be able to capture the difference between when they sold at $95 and they purchased back at $88, for example. You see this a lot, especially come earnings season. A recent example of this I was able to see live happened earlier this year in 2025, and it was for Roblox during their earnings call. Roblox always releases earnings in the morning and tends to be a pretty volatile stock. During the day of this particular earnings call, the stock price dropped by over 30% before the market even opened. And you can imagine you have a market maker flooding the market with sell orders. It's triggering these stop losses, further taking the price downward. And by the time the market opened, the price was only down 12%. So someone was able to capture the spread between it being down 33% and it being down only 12%. So if you watch markets on a daily basis, especially around times of earnings, you can see these volatile price fluctuations in either direction that'll either create an artificial impression of scarcity or an artificial depression of demand. So in an example, when they might spoof demand, you'll just see the price go up instead of down. In these cases, it could be possible that you have a fund that is shorting the stock after the price goes up. So for example, they might be able to push it up 10 or 15% before the market opens without a lot of money. Once the market opens, you have a lot of retail investors that continue to buy, and then they'll start selling their shares. They might go short on it, and they'll be able to profit that way. And these are all tactics that are not legal. One of the terms used for these types of tactics is called painting the tape. It's creating a false impression of what's happening on the markets. You can think of painting the tape as creating a lot of movement and volume. So if you do pay close attention to markets, you'll be able to see volume at the bottom of a chart. It's in red and green depending on whether there's buy or sell orders. And that's where you get the term painting the tape. So if you have a market maker, potentially two hedge funds, and they're just buying and selling securities amongst themselves, it can create this false impression of volume, and that is not legal. But it happens rather often. Additional ways that market makers can manipulate prices is they'll pick and choose what orders show up on public markets compared to what orders happen in dark pools or on private exchanges. A lot of times when you have large institutions purchasing stock, they don't want to do that on a public exchange. If a hedge fund wants to buy $2 billion of a stock that has a $100 billion market cap, if they place that order on a public exchange, it's going to shoot the price upwards. In turn, as those orders are being filled, they'll be paying higher and higher prices for those shares. So when they don't want to have an impact on the market, they conduct these orders via dark pools. That just means they're doing a private exchange with another institution. So without having stock trade on a public market, they can trade $2 billion for X amount of shares at an agreed upon price, and retail investors will never notice it watching stock movement. On the flip side, if they're doing a large sell order, they might want that to show up on the market, so it does negatively impact the price. Let's say a fund wants to start short selling one of their positions. They open up the short position, and then they sell their own inventory, and it starts triggering stop losses for other people. So even though they're offloading their shares at a lower price, they're already on the other side of the trade betting that the stock's going to go down. Now, the SEC is supposed to ensure that they're maintaining fair and orderly operations for these market makers. This wording itself is loosely defined and is hard to enforce. Some of these items are gray areas, others are outright illegal. And as we mentioned earlier with Jim Cramer, he says that most of the time the SEC is just too stupid to understand what's even happening. Next, we'll talk a little bit about the dot-com bubble. So the dot-com bubble happened in the late 90s running into the early 2000s, and it was when we saw the rapid growth of the internet. A lot of what you saw for retail investors was they were buying and selling website domains. Well, outside of that, as it actually related to the stock market, we saw new tech companies pop up, and they had very high valuations, and it eventually led to a deep crash for NASDAQ. At the time, the chairman of the Federal Reserve was Alan Greenspan, and he coined the term irrational exuberance in respect to the current stock valuations. The dot-com bubble as a whole led to massive investor losses, and only a few companies rose from the ashes. Some of the more notable ones would be Amazon and eBay. One of the most devastating crashes actually came from Cisco stock, which is a big company that's still around today. Their stock price had gone from around $2 to over $70, and many of their employees were being paid with stock options. They had turned into millionaires or multimillionaires overnight, and they had faith in the company. Valuations for all tech companies were growing, and they were putting their retirement back into Cisco stock via their retirement plans, 401ks and the like. So when the stock crashed from $70 back down to single digits, not only did you have people losing their jobs, but they were losing all of the money that they had saved up. It took close to a decade for most of these losses to be recovered by NASDAQ as a whole. And for specific companies like Cisco, it would take upwards of 20 years for them to recover. With that being said, the vast majority of the companies that were part of the dot-com crash completely ceased to exist and filed bankruptcy. Recently, there's been comparisons of what people are calling the AI bubble today with the dot-com bubble of the 90s and early 2000s. We even had just a couple weeks ago, Federal Reserve Chair Jerome Powell mentioning the extended valuations of stocks. He didn't use their rational exuberance, but it is rare for the Fed to talk about the pricing of markets, and that was something that was brought up just a few weeks ago. Next, we'll talk a little bit about the SEC. We had mentioned them earlier when it comes to market makers, and they regulate markets and their participants. SEC stands for the Securities and Exchange Commission. Their whole goal is to create transparency in markets. They want to ideally protect investors, specifically retail investors. For the most part, they think that institutions and hedge funds, they have enough money that they don't need specific protections, but people like you and me, we don't have a lot of money, so they need to put rules and governance in place to make sure we're protected. Now, there's a large group of people in the investing community that don't think the SEC has the average person's best interest in mind. You can see an example of this when Elon Musk talks about the corruption of the SEC, and a lot of people, both retail investors and institutional traders, rallied behind him to agree that the SEC is corrupt. A few examples of this would be Robert Brian Thompson. He admitted insider trading in 2024, and he was an SEC member, and there's a pretty strong track record of SEC members leaving to go work at the same banks and funds that they were supposed to be regulating during their tenure. The idea with this is if someone has an incentive to go make 5 to 10 times more money working at a bank that they're supposed to be regulating, they're probably not going to regulate them too harshly. They're going to turn a blind eye to a lot of the things that are happening that might be in a gray area or potentially outright illegal. If members of the SEC were actually tough on crime, they wouldn't be able to leave and get these high-paying jobs at hedge funds and banks. Trump himself has even stated that the SEC is corrupt and they need reform. And right when he got into office, he ousted Gary Gensler and put in a new chairman of the SEC. Moving along, we'll take a look at Charles Schwab. So Charles Schwab is a large bank and brokerage. They're also an investment advisor. They were really the pioneer of the discount brokerage that was more focused towards retail traders. They offered lower costs and self-directed investing. So it wasn't just you going to a professional and them telling you what to invest in. They made it to where there were reasonable fees you could pay for buying and selling stocks, and you could choose what you wanted to buy and sell without someone else necessarily influencing you. Now, Charles Schwab has been part of several controversies. One of the more recent ones is for a $180 million fine they had to pay to the SEC regarding their robo-advisors. For those of you that aren't familiar with robo-advisors, they're effectively a way to automate stock trades that retail investors often use, sometimes institutions. But most of the time for institutions, robo-advisors don't work just because the tools that they're implementing doesn't scale with the amount of money they're using. The SEC found that internal reports from Schwab said that they knew that their robo-advisor strategy was less profitable for their clients, but they continued to push it anyway because it was profitable for them. Alongside this, they also hid a lot of the profits that they got from using these robo-advisors. So for example, someone would put $100,000 into this robo-advisor fund that's supposed to be buying and selling stock on their behalf, and maybe $90,000 of that $100,000 was currently invested, and say $10,000 of it would sit in cash. And during that time, Charles Schwab wasn't paying any interest on that cash portion of the robo fund. With that being said, Schwab would take the cash from the robo funds that were aggregated from all of the investors. They would then route that money to their own affiliated banks and loan out that money to collect interest on it. Then they kept the interest for themselves. They didn't give it back to the clients. So these clients had what they thought was cash sitting in a fund, when in reality, Charles Schwab was taking that cash and loaning it to other people to collect interest on it and not pay it back to the investors themselves. Now, this would be perfectly fine if they were disclosing that your cash funds would be used for them to loan out to investors and you'd get, a 50% cut or even say 10, 15% cut. The problem was they didn't disclose this to the clients, and that's what led to the SEC going after them. Next up is private Discord. So we had talked about Discord channels on episode 2 of the Iceberg series. Private Discords are going to be slightly different. It's just that they're going to be more private. They're going to be invite only, and it's theorized that these are more likely to be used to orchestrate more coordinated market manipulation and more coordinated pump and dumps, and even potentially share inside information. There's a lot of private Discords that are rumored to just have institutions on them talking between one another. And this became more popular as Wallstreet bets on Reddit grew. In 2018, for example, there was a Wallstreet bets poster that was continually leaking information from major investment banks on the weekend talking about the moves they would be making on Monday. These posts were often shut down within 30 minutes to 2 hours. And what came of this was a set of private Discords where this information would continue to be shared. Again, this is something that skirts in the gray area of, is it non-public material information to be sharing it? Regardless, you'd imagine it's some type of fraud or manipulation to be stealing emails from a large bank or institution and spreading their internal plans on a public forum. In regards to Wallstreet bets, repeat bans and increased moderation just continue to lead more users to moving to private Discords to share this type of information. This was before the Reddit IPO. It was a couple years before, but they were still wanting to clean up what was on the site. That way they didn't have any dirty laundry when they actually went to go public. This is a topic that's slightly related to the dark web forums, which we'll get on later, which pretty much are outright used to share inside information. What we'll take a look at next is market bubble theory. So market bubble theory recognizes that markets often experience rapid rise in prices leading to irrational valuations. You'll see this in commodities, real estate, and various financial markets. Something important about believers in the market bubble theory, they are not believers in rational market theory. So there is a relatively large section of people that believe that markets are rational, that inside information even will not affect the price of a stock. Everything is already priced in. For people that believe in the bubble theory, they don't think markets are rational. They think that investors are often irrational and make decisions, good or bad, regardless of the type of information that they have. The hypothesis in general says that these rapid rises in valuation will be followed by sudden crashes. The biggest thing to note is no one's able to know the timing of when investors will actually start cashing out. And the reason is they don't think the market is rational. So there can be as many signs as you can ask for to predict the top of a market. And if you're a believer in market bubble theory, you understand that valuations can keep going higher. Investors aren't listening to that information. They're not making rational decisions. And the same can be said for when the sell-off happens. They'll sell off beyond the point of fair valuations and crash prices even lower than intrinsic value. Next up is SHIP. SHIP is the ticker for a shipping stock, and shipping stocks in general is something that's had me fascinated since months after I got into the stock market. In my opinion, it's a miracle that any of these companies are allowed to stay listed on the NYSE. From the outside looking in, they look like total scams. It looks like they're defrauding all the investors and everyone involved should be in prison. For example, if you look at SHIP and you go to Yahoo Finance and you look at the all-time history, if you go back to when the stock IPO'd and look at the price, it'll say it is billions of dollars per share. The reason being is that these stocks continually do reverse stock splits to raise more money. For SHIP, let's say they have 1,000 shares listed at $1 a piece for a market cap of $1,000. For a reverse stock split, they would decrease the total amount of outstanding shares to 100, and in turn that would raise the price to $10 a share. So every person that had 1 share of stock now has 0.1 shares of stock, but it's valued higher. What this does is it lets the price seem like a reasonable number as the stock is falling towards zero. So on the reverse side of that, if you look backwards in time, it inflates the price of the stock. So that's why you'll see on SHIP, for example, it looks like the price was in the billions of dollars. But these seem to asymptotically go to zero as you have the reverse splits. It does make the price still seem like a reasonable amount instead of just fractions of a penny. Pretty much all of the shipping stocks are known for high volatility. It's very common for them to move 20 to 30% in a day. You'll often see weeks where they might rise several 100% in value. Again, zoom out on a 5-year chart, especially a 10, 20-year chart, is not even a bump in the road, these 100-200% moves. This is just a prime case for diluting the shareholders. They continue to sell stock, they issue more, they do reverse splits, and the only percent helps is the insiders that are cashing out. For anyone that is long these stocks, they are losing all of their money. And in the case of dilution, normally these shipping companies are selling this new issued stock at a discounted price to institutions. And when institutions get it at a discounted price to the market, they immediately sell and dump the price. And that's why they're having to do the reverse splits to inflate the price back up. So it's not just going to fractions of a penny. Apparently, the SEC has limited authority for prosecuting these companies just due to the complicated legal structures of the entities and obfuscation of their owners. The whole industry of international shipping is fascinating. It seems like everything is just a big circle, a web of no one owns anything, and you can't find any information about who's actually controlling a company. And when you really think about it, it's amazing we've ever been able to coordinate international exchange, especially when there's so much complication behind the flow of the money and how these companies are actually structured. If anyone's interested, I'd be happy to do a deep dive into shipping as a topic as a whole. Again, I just find it fascinating. It's full of corruptions and illicit activity. And then we have Luckin Coffee. So Luckin Coffee is a Chinese coffee chain that was a massive pump and dump back around 2018 or so. And they were found guilty of accounting fraud. They had inflated their sales by over $300 million. Now, Luckin Coffee found its way to get listed on the NASDAQ, and they ended up facing close to a $200 million fine from the SEC for this fraud. A year later, they ended up filing bankruptcy. Of course, as mentioned, they got delisted from NASDAQ, but now they've recovered. They're still trading on other exchanges, and it seems that they have new management in place. They're no longer lying, and they've opened up close to 30,000 locations at this point. This in general was a bit of a turning point for America as a whole. Between 2014 and 2017 or so, there was a big run up in Chinese stocks. There were a lot of Americans that were interested in Chinese companies, and this gave Americans fear into investing into Chinese-owned companies, worried that a lot of them were committing accounting fraud, and it wasn't going to be caught by the regulators in China and other countries that they were trading on. Again, Luckin Coffee has recovered. They seem to be growing fast and with new management. So it'd be interesting if at some point they're able to get relisted in the US. Up next is a big one, and it's Enron. There's a lot of good videos on Enron. I'll leave a link to one below that I like that I think is easy to understand by Crayon Capital Video. In short, Enron was one of the biggest pump and dumps during the Dotcom Bubble. They were an energy and commodity trading company, and they opened up an online exchange to exchange these commodities. It made it very easy for the average person or even institution to use the internet to move large amounts of money and speculate on the futures of energy. In short, a lot of the executives went to jail and the company filed bankruptcy. Investors lost tens of billions of dollars. They were using what they would describe as complex accounting to overstate their earnings and hide their debts. In reality, they were committing straight up fraud. What they had done is they brought on the CFO. His name was Andy Fasto, and he had the idea of creating special purpose entities, or SPEs. So these SPEs were effectively subsidiaries of Enron that would have these obscure names. They would just be numbers and letters. There was really no creativity behind it. And these entities would buy Enron's bad debt and their failing contracts. So for example, if Enron signed a contract with a large corporation to sell them energy at a fixed price, and Enron was losing money on that contract, they would sell it to one of these special purpose entities. And the way they did the accounting for it, it made it look like the special purpose entities were outside investors. So when you're looking at their public filings, 10Q for example, it appears that all of their bad debt and poor investments, they're getting paid for. They're offloading risk and at the same time getting paid for those assets. In reality, they were just moving that money to a subsidiary of themselves. So the money was still there. It was still a problem. It was still their bad debt. It was still their bad deals. But it made it look like they were getting rid of those and getting paid to get rid of those. Additionally, a lot of the hype around them was that they had created a new financial instrument. They were selling energy futures. And when it comes to the accounting fraud side of this, when they would sell an energy contract, they would recognize the full amount of the future potential revenue as actual revenue today. So for example, they might sell a $100 million energy contract that is $10 million a year over the next 10 years. And instead of them recognizing $10 million in revenue this year, $10 million next year, $10 million the third year, they just recognize $100 million today, even though there's no guarantee that that contract would be fulfilled. All in all, it's one of the biggest examples of accounting fraud in US history, and I'll leave a link below for the Crayon Capital video if you'd like to check it out. Lastly, we'll cover shorting or short selling. Short selling is betting that a stock's price is going to go downwards. That's how you profit off of this strategy. What happens is you borrow shares from an institution, for example. You then sell them on the open market with intentions to buy them back later and give them back to the institution plus interest. Short selling in itself actually lowers the prices of stocks as you offload them on the open market. So let's say you want to short sell Apple and you borrow 100,000 shares of it. When you sell 100,000 shares on the open market, that within itself lowers the price. And the way for you to profit on this is you need to buy 100,000 shares back at a lower price and then give them back to the institution. If I can sell shares at $100 and then 6 months later I can buy them back at $50, I profit the $50. One of the issues with short selling is it offers unlimited loss potential, but there's only a limited amount of gain you can have. For example, a stock's price can only go down to zero. So if I short sell one share of a stock at $100 and then I buy it back for a penny, I can make $99.99 a share. But that stock's price can go up infinitely. So if I short sell it at $100 and it goes up to $1,000, I can lose $900 a share plus interest, because eventually I have to buy those shares back and give it to the institution plus any interest. Again, it's used to bet on a company's stock price going down. And this is actually a practice that is banned in some parts of the world. Korea has done a ban on it. Other countries will do temporary bans on it when their stock markets are facing significant declines. Reason being is that, again, when you short sell, you're putting more downward pressure on the market, so it forces the price lower. So for short sellers, they themselves can trigger stop losses and then buy the shares back and give them to the institution and profit relatively quickly, depending on the situation. Now, if you hold stocks, your institution might actually be lending your shares out to short sellers. And this was a big thing that came to light during the GameStop scandal that a lot of people weren't aware of before, because with the GameStop situation, we had more than 100% of the shares outstanding, more than 100% of the total shares available for GameStop were short, which isn't supposed to ever happen, but it did happen. So exchanges and institutions were lending out shares for people to short that didn't exist, that they didn't have. And you can opt out of lending your shares. For example, with Robinhood, they'll pay you a small fee. Most brokerages will pay you a small fee if you'd like to lend out your shares. Now, it does open you up to certain risks. For example, if your institution does lend out shares and they lend out yours plus shares they don't have, and then they face a collapse, you might not necessarily be covered by FDIC insurance or SPIC insurance. So that's something to be aware of. And typically you get a small amount of money for lending your shares, and the exchange or institution is collecting 95 to 99% of the interest they're getting from those short sellers. But it is something you can opt into. And short selling can often lead to short squeezes, like we saw with GameStop and like we'll talk about later with K-Bio. A short squeeze happens when you have a large percentage of shares short and the price begins to go up. Or with the GameStop scenario, you have more than the available supply short, and then retail starts buying and the share price goes up. Like we mentioned earlier, short selling does have unlimited loss potential. Now, any investor that has any type of savvy is going to hedge against unlimited losses. And the way that they do that is by going long the stock. So they purchase it. They might also purchase call options, which, to simplify things, is a bet that the price is going to go up. And when you have short sellers start going long on the stock, it pushes the price up because they don't want to lose an unlimited amount of money. So they have their short position. They know it's no good. They know they're losing on it, but they'll start going long on the stock. So they are holding some underlying asset and it's limiting the total amount of money they can lose. Couple that with calls, and that can also limit the amount of money that they can lose. And when you have a large percentage of the total shares short, you have a lot of large traders with lots of money that need to cover. And when they're covering and they're going long on these positions, that's when the price starts going up exponentially. And that's why we call it a short squeeze. It just squeezes the price straight up. Again, a couple famous examples of this are GameStop and the K-Bio short squeeze. There was also a short squeeze for Volkswagen, and they're pretty common in the crypto industry as well. Specifically with crypto, you'll have a lot of exchanges that are naked shorting assets that they supposedly hold on their platform, but a lot of time they don't hold it. So for example, this became apparent several years ago with Bitcoin Cash on Binance. People were having issues withdrawing Bitcoin Cash from Binance, which hints to the idea that they probably don't have Bitcoin Cash and they're just selling you paper. They're selling you an IOU. And at the same time, it was speculated that Binance was short selling Bitcoin Cash. So they were taking all of the Bitcoin Cash they had, or they were borrowing it from other exchanges and then immediately selling it on the market. They were making it to where their users could not withdraw the Bitcoin Cash, but they could sell it or they could exchange it, which forces the users to sell the asset, especially as they get scared and the price goes down and they can't withdraw it from the platform. And that just creates a bunch of sell pressure on the price and lowers it even more. And eventually what you had was a large portion of the Bitcoin Cash community. They started moving all of their Bitcoin Cash off of exchanges. They got it out of decentralized exchanges that were lending their Bitcoin Cash, and they just held on to it. And when they hold on to it and you have new buyers coming in, these short sellers eventually see the price is rising and they have to cover. And that's a good speculation as to why we saw the price of Bitcoin Cash rise from $110 to $700 back a couple years ago. And to wrap up short selling, this last piece wouldn't apply to crypto because crypto doesn't produce anything. But for companies, oftentimes short sellers are banking on a company filing bankruptcy. And in extreme cases, short selling itself can be the reason why a company has to file bankruptcy. If total faith is lost in a company because short sellers continue to dump shares on the open market, and in these extreme cases, you have more shares short than there are available, it creates distrust in the company. The company's share price goes from $100 down to less than $1. It's hard for them to bring in new investors. It's hard for them to get an influx of cash, and it's hard for them to feel like they have legitimacy. So there is this problem with short selling that it can force what might be fine businesses otherwise into bankruptcy. This is a reason why some people frown upon short selling. Other people think it's a really good idea to use as a hedge for your portfolio. You know, we talked about the dot-com boom earlier and how the vast majority, high 90% of those stocks went to zero. It's hard to find data on this, and I swore I had read a study about it back in 2016 or 2017, but you can use common sense. Think about every stock that's ever been listed on the New York Stock Exchange, which opened back in the 1700s. Most of them don't exist anymore. Over 99% of them have ceased to exist. They've either gone to zero, they filed bankruptcy, they've become part of a merger, which is a little bit different that could positively affect the share price. But the vast majority of companies that have ever been listed are no longer listed. And people use that logic to say, well, maybe stocks don't always go up. Maybe if I take an average stock, it actually has a propensity to go to zero. And that's why a lot of people will short. And we'll talk about Martin Shkreli in a later episode, but he's stated online that he holds a portfolio that is 20% cash, 20% long, and 20% short. And he was actually the quote-unquote orchestrator of the K-Bio short squeeze, which we'll cover here in one of our later episodes as well. With all that said, hopefully you all enjoyed today's episode. Like, subscribe, and be on the lookout for part 2 of Tier 3 of the Wall Street Iceberg. We'll be taking a look at leaps, short interest theory, and one of my favorites, which is prison stock, along with a dozen or so other topics. Thank you for watching, and we'll see you next week.